Hey guys, welcome to another episode of the Onvisor podcast. My guest this week is Mark Pahwa from PPI. Now, Mark is a specialist in segregated funds, which is a mix between investment and insurance products. Seg funds are a very unique product and they serve very specific needs in wealth management. So my conversation with Mark dives into not only how he got into the financial planning and financial advisory business, eventually advising advisors on how to approach certain cases or particular client needs. But we also dive deep into this very particular and very interesting investment product called segregated funds. So I hope you guys will enjoy this episode as much as I enjoyed hosting it. Here's my episode with Mark Pahwa from PPI. All right, Mark. Welcome to the show. So how was your week so far?
Hey, so far so good. You know, September's here, summer is over, and it is go time now.
Yeah, people are getting back to business. I know for myself, I tell people I don't necessarily swim against the current in the summer months. People don't want to talk about money.
Yeah.
But as soon as September, October hits, school starts, people jump right back into it.
Yeah, absolutely. Yep.
Yeah. All right, Mark. So to start off, tell me a little bit about yourself and how you ended up in the business of helping people with their money.
Yeah, for sure. I mean, my father was an advisor himself, and this goes back years ago. And you know, I had similar aspirations, I suppose, and kind of one thing led to another, and I was ended up taking a back office role at some big Canadian asset managers, names you probably know, Mackenzie and CI. And ultimately, my objective was to get into more of a front office, client-facing kind of role, and I transitioned into a sales capacity and ended up working as an inside sales associate at a boutique fund company. And spent some time there and transitioned to a VP role where I was on the road as the wholesaler, and I was covering Ontario and parts of Western Canada as well. Okay. And at the time we had exclusive access to equity markets in India. We were a boutique emerging market shop. We would launch closed-end funds, ETFs, and you name it. So really kind of cut my teeth at that side of the industry. And ultimately the firm was bought out by a big global player, a big Canadian-based global player. And that's when I transitioned into another role, also in a sales capacity, but working with a digital investment solution. It was known as Wealth Bar at the time.
Okay.
I did that for a little bit, and then transitioned to my current role, where I help all types of investment advisors with insurance-based investments.
Yeah.
So there are a certain class of investments that are governed by insurance legislation.
Yep.
And all types of investment advisors, and most clients, quite frankly, have a home for this type of solution. So I transitioned into this role, and now I help investment advisors and portfolio managers with segregated funds and other insurance-based investment solutions.
Okay. So for somebody who doesn't know what a segregated fund is, you explained it briefly, but could you kind of unbundle that as how is the marriage of investments and as opposed to traditional, like how do they compare to a mutual fund, let's say? So what is a seg fund for somebody who doesn't know?
Yeah, no, that's a great question, and it's one we get frequently. And I think you've hit the nail on the head. Segregated funds may not be as well known in the marketplace or as well known by the Canadian consumer.
Yep.
But they absolutely have a home. And as I like to say, segregated funds solve problems.
Yeah.
And that's a pretty elaborate statement. So pretty pointed statement. So we'll elaborate on that in a bit. But to answer the question, a segregated fund is in a lot of ways similar to a mutual fund in that it is an amalgamation of publicly traded stocks and bonds.
Yeah, traditional investments.
Absolutely. Yeah. So from that perspective, it's a group of securities, and they can be broad-based, or they can be country-specific or industry-specific, or have a filter on them. From that perspective, they're almost identical to a mutual fund. as I mentioned at the outset, they are governed by a different legislation. And so a segregated fund is actually a trust. And more specifically, it is an inter vivos trust. And that
Okay.
is a trust between lives. So, in the case of a mutual fund, what happens when the owner of the fund passes away? Now, if it's a simple case and we're talking about registered accounts, well, here in Canada, we're lucky that our registered accounts have what is essentially equivalent of a named beneficiary. If you're married, you have a spouse, something happens to you when you pass away, your RSP will roll over to your spouse without triggering a disposition.
Yeah.
This wouldn't be a taxable event.
That's right.
Now, for affluent individuals, for business owners, for those folks who have unregistered money as well, it's like, well, what happens to a pool of unregistered money? So one aspect of a segregated fund contract, one extremely powerful component, is the named beneficiary.
Yeah.
And we can actually name a beneficiary at the contract level so that when the primary owner and annuitant of the segregated fund contract passes away, the assets will flow to their beneficiary without flowing through probate.
Just like a life insurance would.
Just like a life insurance would. And I mean, that actually brings up another point. In some cases, individuals buy life insurance purely for the death benefit.
That's right.
Of course, if you need a death benefit, you need life insurance, you have to go through a full underwriting process.
Yeah.
And not everybody is insurable, as you know.
Yep.
So if the objective for the life insurance is to achieve a death benefit, we can achieve that with a segregated fund contract without being underwritten. Anybody can qualify for a segregated fund
So it's like
contract.
self-funding it, while getting all the advantages of life insurance contract. Basically.
Absolutely. And, there are some additional benefits as well. And I said at the beginning, segregated funds solve problems. And, what exactly does that mean? And what types of problems would a segregated fund solve? And oftentimes we see, affluent individuals, those who are in the high net worth or ultra high net worth space, they tend to have more elaborate estates. They tend to have more intense desires for their capital after they're no longer here.
Yep.
And oftentimes the thought process is, well, I must go and establish a trust. I
Yeah.
have to go and find a trust.
Yeah, you got to spend that money and get that set up.
There you go. And in some cases, in even more elaborate cases, a trust is required. And there are certain instances where there's really no alternative for a trust.
Yeah, for private assets and other, small businesses, stuff like that,
there you go.
Can't get wrapped into a seg fund. But
there you go. I mean, people have cottages, people have multiple properties that they want to distribute among their children, and so in some cases we need a trust. But oftentimes, an affluent individual will be quick to think they need to establish a trust when a lot of what they're looking to accomplish can be achieved at the application level with a segregated fund.
Yeah.
And so we talk about, privacy. When you pass away, when I pass away, our estate is a matter of public record.
Yeah.
Anybody can go down to City Hall and check what happened with your estate, where you distributed your assets, who got what, and how much was left.
Yeah.
And this can pose an issue. It poses an issue for affluent individuals who may have somebody challenging their estate.
Yeah, exactly.
So if we want to leave a lump sum to a beneficiary and we want this to be private and we don't want anybody to know about it, well, we don't have to run and establish a trust.
Yeah.
Because again, if we do, we're subjecting ourselves. We need to hire a trustee. We need to sit and administer the trust at least on a yearly basis. There's tens of thousands of fees that go along with it. There's a 21-year rule, forced disposition, taxable event every 21 years for a trust. None of these factors come into play if we establish an inter vivos trust through a segregated fund contract.
Yep.
So back to my point. For an individual who has some privacy concerns, wants to leave a lump sum to a beneficiary or an annuity for that matter to a beneficiary, we can do that at the application level with the segregated fund contract.
Right.
When the owner of the contract passes away, The death benefit, well, when the annuitant has passed away, the death benefit is triggered, and the assets will flow to the beneficiary outside of the estate.
Right.
So the beneficiary will receive what was earmarked for them in a matter of days or weeks. We do not have to wait for the estate to settle.
That's
We
right.
do not have to wait for probate court, and we are not subject to the public nature of an estate.
That's right.
So this is an extremely powerful tool for those individuals who have privacy concerns with their estate.
Yeah. And you mentioned probate. You're also saving on probate fees. How much are probate fees right now again?
I mean, absolutely. And probate fees can vary depending on province and jurisdiction.
Yes.
But, anywhere up 1-2% of the overall estate.
So if you have $5-10 million estate, that's a chunk of change.
That's an absolute chunk of change. And again, if you have that type of estate, odds are there's some complications there, or it's a bit more elaborate, and it will take a long time for the estate to settle.
Yeah.
So if your beneficiaries have immediate capital requirements, establishing a segregated fund contract will make sure they're able to get where they are going in a quick time.
Yeah. And another angle, I guess, that I'm more and more seeing segregated funds be of value is, the more affluent the person, the more control they tend to want, and I find segregated funds, as you've just been mentioning, gives you a lot of control of what to do with that money and where it goes and who knows about it and, who can contest it or not. And so for me, it's a lot about control. Tax savings, yes. Privacy, yes. Not paying for probate, yes. Like all yeses. But at the end of the day, I feel like it's like the client remains in the driver's seat, right? And clients love that.
I love that you use the word control, because this is one of the things we say: control your estate from beyond the grave.
Yeah, right.
And, and with the segregated fund contract, exactly as you've said, it allows you to have control over what your objective is. And another great example, and not even, I mean, the other one we just mentioned may have been exclusive to affluent individuals, but here's another type of problem, let's say, that a segregated fund can help solve. I mean, imagine you have multiple children, and let's say one of them is a productive, contributing member of society, and they're well employed and a family individual, and they're financially responsible, and they take care of themselves, whereas my other child doesn't have that same gift, and maybe maybe there are some issues, or maybe there's
health issues,
or health issues, or even like gambling, or for whatever reason maybe the individual isn't super adept at managing finances. So now, if I were to pass away, I want to make sure I split split the inheritance among my children, and I do want to make sure it's equal. But I also have concerns that my second child may not be able to manage a lump sum.
Yeah.
So, maybe I want to give my first child a lump sum because I think they can manage it, but I'm reluctant to give my second child a lump sum. It's like, how do I solve that problem? Well, okay. Again, I can go and find a trustee. I can establish a trust that says, okay, when I pass away, we're going to split my estate in half. We're going to make sure that my first child gets a lump sum, but I want to make sure my second child gets money every year for the rest of his life.
Yeah, or monthly.
There we go. We get a monthly income for the rest of his life. Now, of course, we can accomplish this with a trust, but for all the rules that I had mentioned earlier, it might not be the most effective or efficient way of doing this.
And the cost.
There you go. And so by establishing a seg fund contract, naming both the beneficiaries, we can give beneficiary A a lump sum, but we can give beneficiary B an annuity.
Yeah.
And so we can purchase an annuity for beneficiary B, and this will allow periodic payments for the remainder of their life.
Yeah.
So now we're accomplishing our goal of making sure both our children are taken care of. We're getting rid of the problem where we think one of our children may not be suitable to handle a lump sum of money.
Of course.
And we're doing all of this without establishing a trust and without going down that road and incurring the time and fees associated with doing that. And you do that at the application level with a segregated fund for only a couple of basis points more.
Yeah. So another situation where I see segregated funds bring in tremendous value is when you have children with special needs, right? Whether they're disabled or impaired in some fashion. Anyways, they need special care or attention. We know we have in our DSP, Registered Disability Savings Plans. There are products in place, but they can only go so far, just like RSPs and TFSAs can only go so far. Can we talk about a use case for, kids or children with special needs?
Yeah, absolutely. And I really like that you brought that up. I mean, special needs planning can be particularly challenging, and segregated funds can play a role in alleviating some of that stress. And we think about a situation. Let's say you have a child who has special needs. Maybe they have Down syndrome or they have autism or something. And typically those individuals will get some type of remuneration from the government.
Yep.
This typically comes in an ODSP payment.
Okay.
So the folks at ODSP, they will assess, your child's situation to ultimately determine how much money they can be awarded on a monthly basis.
Yeah.
Now, the objective for those individuals in some cases is to, in some cases they can work, or they maybe they get an inheritance, or they come around some money through another way. And the challenge is always, how do we account for that extra income the special needs individual has without eroding their government benefits?
Right.
And because if the child, the individual with special needs, if they acquire a lump sum or if they get a raise at work or whatever it is, well, then the government's going to say, okay, now you're making too much money. So we're going to claw back some of that ODSP that you get on a monthly basis.
Right.
So these individuals are allowed to have $40,000 in personal assets before their ODSP gets clawed back. Typically, that $40,000 sits in a TFSA is what we typically see.
In assets or income? Assets?
Assets, yeah.
Okay.
Assets, assets in their name, up to $40K without eroding their monthly benefit from the ODSP. Now, a segregated fund is exempt from the calculation.
Oh, wow.
So if we have an individual, let's say up to $100,000. So if we have an individual, maybe you have a child who has special needs. They are on ODSP. They do get, let's say, $900 a month from the government. They have $20,000 in a TFSA. You really want to make sure that they're taken care of when you're no longer around.
Yeah.
Well, what do we do? I mean, okay, we can buy a segregated fund, name our child as the beneficiary, and up to $100,000, that amount is exempt from the ODSP calculation.
Wow.
So this actually allows an individual who has some special needs planning requirements to leave some money for a child beneficiary with special needs without eroding the benefits that they're getting under the guise of ODSP.
Wow. So, that's a huge advantage.
Absolutely.
Yeah. One thing that, so I have two kind of powerful guidelines that I use for advice. And one of those is flexibility. I always prioritize flexibility because life changes, things change, you need to adjust, course correct, etc. And segregated funds can be quite flexible and accommodative, right? Like, I think you think of insurance, sometimes you think of something more rigid. Can maybe we dive into debunking in all insurance products or annuities being like rigid or too rigid to accomplish goals?
Absolutely. And I really love that you brought that up. And I think some of the verbiage traditionally surrounding segregated funds is that they're expensive, they're restrictive, they don't have access to a whole host of investment options or investment solutions, and they're really only suitable for a certain type of client. Yeah. And I can say that nowadays, basically none of that is true. And we look at a fee conscious world. And we know the impact that fees have on the end result of investment performance. But we've seen segregated fund MERs come down substantially. And what we're seeing now is segregated funds on par, more or less, with mutual funds.
Definitely a branch level mutual fund for sure.
Absolutely, yes. And I think in some cases, depending on the guarantees associated with segregated funds, and we'll get into that in a little bit. Yeah. So depending on, the investment mandate and the guarantees, we still can see a spread between a mutual fund MER and a segregated fund. But in the end, you get what you pay for. And the cost only matters in the absence of value. And if a segregated fund is adding value to you, your estate, your family, a slight increase in MER, that conversation more or less falls by the wayside.
Absolutely. You get what you pay for. And I remember the first time we met for coffee, a light bulb went off in my mind. I don't know if you remember, but I was like, okay, if a seg fund does fit, because I for a long time, I haven't positioned this as much as I should have, or talked about it as much as I should have in my career, because I was focused on fee first, traditional wealth products for a long time. But now I'm seeing the control aspect, the guarantee aspect. I'm seeing the value more and more, and we'll dive into more circumstances where it's a fit. But you can also invest a little bit more aggressively to compensate for the higher fee. So if somebody understands investment, has the time horizon, like I'm, later on in age and I'm looking for wealth preservation, but I'm investing in a seg fund for my kids who are only 20 something, I can go all stocks as opposed to a balanced portfolio, which I would do for myself. I'd be balanced in my RSPs and stuff I'll be spending in my lifetime, but I can go all small cap US stocks, seg fund for my kid. And that extra 2-3% of expected return over 30, 40 years will handsomely compensate me for the extra 0.5, 0.6% in a seg fund.
Absolutely. And I think you're bang on there. And, going back to my previous point, it used to be the case where if you were investing in a seg fund, you didn't have access to the full realm of investment options.
No emerging markets, no this and that.
There you go. Yeah. There you go. And now this world has changed. And if you're looking for, some of the more esoteric asset classes, maybe like a country specific, developing market, or maybe, a precious metals mandates, well, these types of mandates maybe aren't available in a segregated fund. But for everything else, I mean, the investment options exist, and it's more or less on par with the mutual fund options.
Yeah, and also, let's not forget, ETFs were brought into the game now. So now you have some passive funds that can be wrapped into a seg.
Absolutely.
Bringing costs just, again, either closer to a mutual fund or arguably sometimes better than a mutual fund, right?
Yeah, and that's it. And we look at some carriers out there, and they'll have a few mandates on their shelf where the seg fund is actually cheaper than the mutual fund equivalent.
Wow, yeah. That's wild. That's wild to me. And so one thing that you've talked about a few times, an annuity. Can you explain in simple terms what an annuity is for people who don't know what an annuity is?
Yeah, for sure. Now, an annuity is a way to spend money now and guarantee a level future cash flow down the road.
Just like a pension.
Just like a pension. So, I mean, money has a time value associated with it.
Yep.
And I can say, I want to purchase an annuity for, I don't know, let's say for my daughter, and I want her to start getting income next year every month for the rest of her life.
Yeah.
So, I mean, there's a formula, and the life insurance carriers, they have, an algorithm that they follow based on age and expectancy and interest rates to determine how much I need to pay now to guarantee a level
actuarial calculations.
Actuarial calculations. And so, I mean, long story short, an annuity is a way, is guaranteed level income for the remainder of someone's life.
Yeah. Or a deemed period of time. So it could be 20, I want it for 20 years, for 10 years. So you can say I want it guaranteed for 20 years, or you can set all sorts of rules around annuities. And fun fact, you can get them covered for inflation, right? So you can have the increase in life. You can have them indexed to the cost of living. So I can say, yeah, I want my daughter to have $5,000 a month for the rest of her life, or from age 40 on, and I want that to be indexed to inflation.
Yeah, absolutely, and we see that all the time, especially if as the yield curve steepens, as we start and as some inflation uncertainty creeps into the marketplace. Indexing your annuity payment for inflation is absolutely a practice.
Yeah,
and as you've said, the annuity stream does not have to be for a life. It can be what we call a term certain annuity.
Yeah, exactly.
Where we guarantee a level, consistent payment for the duration of a predetermined term.
Amount. Yeah, exactly. So a lot of control.
Yes.
A lot of control here.
Mm-hmm.
So let's talk about these guarantees and resets through seg funds. So there is a guarantee, there's 75% guarantee, 100% guarantees. Walk us through what that means for the investor or the annuitant or the person who sets this up.
Mm-hmm.
This is an insurance contract. Insurance usually means guarantees.
Mm-hmm.
So what kind of guarantees, what kind of reassurances do you get through a seg fund vis-a-vis the money you're putting in?
Yeah, good question. So we talked about, some of the estate protection benefits of segregated funds, and we talked about the bypass of probate, the security, the privacy. But as you've mentioned, another huge component of segregated funds are the guarantees associated with them. And every segregated fund will have a maturity benefit guarantee and a death benefit guarantee.
Yep.
So the death benefit is probably the more important of the two.
Yeah.
Now, if I'm an affluent investor, I have unregistered capital invested, I'm worried about my estate, what will happen to my assets when I pass away. So, I can invest when I pass away. That amount goes to my beneficiary. That part is straightforward.
In a seg fund,
Yeah, in a segregated fund. So what we can do with the death benefit guarantee is we can lock in the high water mark of the portfolio and have that as the death benefit.
That's
so
right.
Let's say, we'll just use some round numbers here. Yeah. I have $500,000 invested and I have a beneficiary, and I want to make sure that my son gets an inheritance.
Yeah.
Now, I also want to make sure that, I have a second wife. That second wife has children from her first marriage.
Yeah.
And they're, let's say, a litigious bunch of individuals.
Yeah.
I don't want the children of the original children from my current wife to be aware what I'm leaving my children from my first marriage.
That's right.
I don't want them to know that.
Yeah.
So what I can do in a segregated fund contract, I can name my son as the beneficiary.
That's right.
And as we've stated at the beginning, this isn't a matter of public record.
Nope.
They will get that without no one will be able to challenge that estate.
Yeah, it's inked.
There you go. It's inked. Long story short. Now, let's say I have $500,000 invested for that beneficiary. And the $500,000, let's say, goes up over an investment window, goes up to $600,000.
Yeah.
So now, if I were to pass away right now, that my beneficiary will receive the $600,000. Now, what if the time passes and the market corrects and 500 goes to 600, 600 goes back down to 525 or 550
or 450
or 450 or 350, 250.
Yeah.
And then when I pass away, now my beneficiary, they're still the named beneficiary. They still get what was left over, but it might be a tough pill to think, last year this was worth 550 and now it's only worth 400.
Yeah.
Well, wait a sec. We can lock in the death benefit with a segregated fund. So we can reset the benefit. We invest 500, market goes up to 600. We lock that in as the death benefit.
And let's not forget that when you set it up at 500, that would be your first set, right? So technically, if it went down to 4 in certain products, and if you died while it was at 400,000, the beneficiary would still get the 500. If you're at 100, that's with a 100% guarantee, which is available. Others are 75% guarantee, etc. But yeah, you'd start at your high watermark is your first initial check, right?
Yes.
And then you just get to increase it, you get the option to increase it as time goes on.
That's exactly it, and you hit the nail on the head. I mean, the invested amount is the first high water mark.
Yeah.
And it's a powerful tool because it's like you were saying at the beginning, it allows you to take on risk that you may not have been in a position to take on.
Yeah.
Because let's say we follow a general rule of thumb for an equity fixed income split in a portfolio. So if I'm, let's say 70 years old, if we're adhering to, traditional, the traditional rule of thumb, I should be in about 30% fixed income, 30% equities and 70% fixed income.
Yeah.
Which, I mean, might be suitable for me as a 70-year-old. But if I'm ultimately investing for my beneficiary, who's much younger, like you said, in their 20s, 30s, well, they can take on more risk.
Yeah.
So now, myself at my age, I can have, instead of a 70-30, I can have a 30-70, and I can have 70% equities, knowing that every year I'm going to reset my death benefit. So if I were to pass away when the market is in a downswing, my beneficiary is still going to receive the high water mark.
Yep. Peace of mind.
Peace of mind.
Peace of mind. Okay. So let's talk about fit. So we used quite a bit of examples here, but let's start with personal situations. So can you name a couple of common situations where where seg funds fit in a personal setup? We'll dive into corporate setups in a little bit.
Yeah, for sure.
But personally,
personally, I think building on some of the stuff we've talked about, like you've said, offering the ability to control your estate from beyond your grave. Yeah. So on the personal side, affluent individuals who have privacy concerns. If there is any issue or any thought that maybe someone can challenge the estate in court, we can avoid all of this by naming a beneficiary.
Traditionally,
there you go. People that was exactly my next point. Blended families, individuals who, like you said, divorcees who have a previous relationship. Maybe the split wasn't amicable. Maybe that individual has this notion that they can challenge my estate, or they can come after the beneficiaries to try and get something additional to what they were left. We can avoid this whole problem with the segregated fund without going through the hoops of establishing a trust. Because like I said, a segregated fund is an inter vivos trust. That is a trust between lives.
Yeah. And, I usually use insurance, and I tell my clients when I work with insurance clients that insurance is a way to control the uncontrollable, right? You can't, and in this case of, divorce or children or family in general, you can't really control what your estate will look like. The people in your estate will look like. Where are they going to be in their lives? What are their expectations vis-a-vis the wealth that you might have accumulated? And insurance, in this case, seg funds for non-registered, for not just non-registered, but also non-fixed asset, like traditional investments. It's nice to have that wrapper of control. Obviously comes at a price, but most people and most affluent individuals, business owners, etc., they've all learned the lesson of you get what you pay for. And, and when you consider the alternative of, like, for somebody who doesn't have a massive estate, and doesn't want to go spend $10,000, $20,000, $30,000 setting up a trust and the lawyers, the accountants, etc., this can be a quick fix. I'd love to jump into the process of application, because this is an insurance product.
Yes.
How does health, age, like what can somebody expect when they're working with their advisor, applying for one of these products?
Yeah, I mean, it's a good question, and like anything, planning goes a long way.
Yeah.
So the application process is very similar, almost identical, really, to setting up a mutual fund. You'll work with your advisor. We'll go through the application form, and if we're transferring assets from another institution, we'll fill out a transfer form as well.
Yeah, which is all done on our end,
all done on your end. This comes at, this is all the process for setting up a segregated fund is virtually identical to setting up a mutual fund. Application and transfer form. Some of the factors that come into play down the road really depend on the type of guarantees you're looking for.
Yeah.
So we talked about the death benefit guarantee, which, as you mentioned, can be between 75% or 100% of the amount.
Yeah.
If we're looking for 100% death benefit and we're getting up in age, that will limit some of the options.
Okay.
You know,
Yeah.
So age does play a factor depending on the type of death benefit we're looking for.
Yeah.
But if we're being completely honest here, so there are carriers out there that are very flexible, and we can get 100% death benefit with a broad range of investable options with one carrier up until the client's 91st birthday.
Wow.
91st birthday. In another case, there's a particular type of segregated fund, a uniquely structured one, where we can actually offer 100% death benefit up to a client's 95th birthday. So to answer the question, age does play a role when we're setting up the contract, but there is almost always a solution given the circumstances.
Okay.
And working with an advisor, somebody who has a team and resources behind them, they'll be able to, scan the marketplace or have some familiarity with the options available to solve the problem.
Now, I think a lot of people shy away from insurance products due to underwriting.
Yeah.
You know, any worries on that front? Any health questions underwriting with this kind of product?
No, and it's a good question, and we touched on that initially there. Buying life insurance means you're being underwritten.
Yeah,
and not everybody.
In most cases,
there are some guaranteed issue solutions out there, but for the most part, we must go through an underwriting process, and of course, not everyone is insurable.
Yep.
If we're buying a segregated fund and we want that death benefit, there is no underwriting whatsoever. So virtually anyone, any Canadian citizen, can work with an advisor and get access to a segregated fund.
So at the end of the day, it's kind of like a pool. The premium you're paying for the insurance wrapper around your investments is kind of like a pooled risk situation.
Yeah.
Where the healthiest of the healthy are pooled with others, and it's just that risk is managed from the insurance perspective, kind of on a everybody's on board kind of situation.
And that's exactly what it is. And and it goes with the resets too. People are they're gonna, if they buy a segregated fund, they're gonna have the resets associated with it. And of course, not everybody in that pool is gonna take advantage of the resets.
Yep.
But there's gonna be some individuals who pass away when the market is on a downswing. And they're going to be the ones who are going to benefit from that.
Yeah. There's attrition within the pool for sure. So let's change gears, and a lot of people who accumulate wealth, accumulate them in corporations.
Yes.
So we've talked quite a bit about the personal need, and have non-registered assets. But let's talk about most of the affluent people have corporate non-registered assets.
Yes.
They sell businesses. They have holding companies where most of their wealth is accumulating. How does a seg fund fit in for these individuals?
No, good question. And there are absolutely some benefits to corporately owned segregated fund policies as well. And, we think about a family corporation, let's say, where we have, a mother and father as key members of the corporation, and their child as maybe kind of a successor when one were to pass away. So traditionally, when the primary annuitant passes away within the corporation, that should be a taxable disposition. That should be a taxable event.
Yeah.
If our corporate assets are invested in a segregated fund policy, well, let's say, mom passes away. Well, dad can move on to be the owner and the annuitant of the policy, and our child, who was the original beneficiary, will now move up to be a successor annuitant. Okay. So we can accomplish this. We can, technically speaking, you can roll over ownership of the corporation indefinitely through the generations of a family. Okay. And none of this will trigger a disposition until it's forced, until someone cashes out.
Yeah.
So if we hold a traditional investment inside a corporation, all of these life events are subject to it's a taxable event. Yeah, it triggers a disposition. Yeah. If we have a properly structured segregated fund contract with an owner, with the successor owner, and with the beneficiary, when the primary owner passes away, everybody's designation within the contract moves up, and it's not a taxable disposition, and there's no taxable event triggered.
Right.
You know, we can also talk about creditor protection.
So we didn't cross that bridge yet.
We didn't cross that bridge yet, and you know, oftentimes affluent individuals they have creditors. Yep. And if something were to happen to an individual, the creditors can come after their estate. If they're owed money, they can sue the estate.
Yeah.
And they can, you know, even if you have this notion that I want to leave, I have some assets earmarked for a beneficiary. Well, if I have outstanding creditors, that can cause an issue.
Yeah,
but if we establish a segregated fund contract, the segregated fund contract is immune to the creditor probe. So creditors can't go after assets in a segregated fund contract.
That's huge.
Because they're earmarked for the beneficiary. Now, I will caveat that the segregated fund must be opened in good faith.
Absolutely.
If you have, I mean, as an extreme example, you know, if I'm driving, let's say I get into a car accident and I have no car insurance and I'm being sued, and then I go and move all my assets into a seg fund contract.
Yeah.
Well, when this gets to court, the judge is going to say that you established the seg fund contract for the sole purpose of avoiding the creditor. So that wasn't established in good faith.
Yeah.
But if the contract was established in good faith, it's immune to a creditor probe.
Yeah. Yeah, exactly. Yeah. Obviously, there's a time lapse. Same with like bankruptcy, etc. Like if you do it the month before, you know you're going to be filing for bankruptcy. Obviously, you know, push comes to shove, might not be this magical, but if it's all done in good faith, to your point, it's the money's being set aside for somebody for a purpose. It's all written in the contract. It's creditor protection. So I think that's all I really wanted to explore. I really appreciate your time. I think this was super helpful and informative. Appreciate you coming by.
Hey, anytime. Happy to be here and happy to do it again.
All right, cool. Till next time. Cheers.
Till next time.